Well, hello and welcome to another episode by Financial Learning. On today's episode, we're going to be breaking down Mullen Automotive's latest 10Q filing. We're going through all of the financials as well as going over some of their litigations and also some of their financing options. So without further ado, let's get right into it. So the first thing we're going to talk about is going to be share count, followed by Mullen's revenue and their cost of operations. The top table there you can see in the green and white, it's going to list Mullen's share count. You can see I have the date of December 31st, 2023, as well as March 31st, 2024. That is going to be the difference in the two earnings. So that's going to be the 3-month period. As well, if you see there May 9th, 2024, that date is important because that's the date that was shared on this specific 10Q, and it gives us one of the most recent share count updates. So looking across all the different lines, you're going to notice that shares from warrants remaining, they've actually stayed pretty stagnant. This specific lender, which would be Aquitas, still hasn't actually exercised any of these warrants. They're still holding as of March 31st. You can see the preferred Series D as well as the preferred Series C and A. They've all stayed stagnant as well. There's been no changes there. What you will see changes of are going to be the common share count. That common share count is listed at that top line, and back on December 31st, it was 5.884 million. And then you'll notice on March 31st, it is 7.974 million. So it did have a quarterly increase of 2,089,751 shares. And then if you are looking at the 10Q and you want to find the latest one as of the filing, or as of the, I should call the preparation of the 10Q, you will find 11,412,596. So that is the total share count to date for Mullen Automotive. We'll talk a little bit about that share count and where some of those shares may have been coming from. As you can see, the warrants actually haven't played any type of factor in that first quarter. So moving into the second section, you're going to notice change in quarter. I have this highlighted in green and red. So the green would be positive. So if you're looking at revenue, profit, and margin percent, anything that's green would be a plus sign when you're looking at the two different quarters. And then if you're looking at the cost, so the general administrative, the research and development, and just overall cost of operations, anything in red means that there was an increase from quarter to quarter. So first thing I want to point out is revenue. Mullen did go ahead and book one of those class 1 vans as revenue for the quarter ending March 31st, and that was for $33,335. You can see the profit for that one van was $19,895, which gave that profit percent about 59.7%. So that's a pretty good amount of profit per vehicle, and we're not sure exactly where this van was sold. We know that there was a poppy florist dealer in the state of California that did purchase a van, but from my recollection, that van was purchased in the current quarter, which would be April through June. So where this one van was purchased, not quite sure, but it is a very interesting profit margin. And if you consider Mullen does have the FTZ now officially, any vehicles that are sold outside of the US are going to have an even larger profit margin than the vehicles that are sold in the States. So with only one single data point, it's tough to say how accurate this profit amount is, but it's good to see that each of these vehicles so far to date that have been sold, we've seen Canvas vans sold, and now we've seen this Class 1 van sold. All of them have had significant profit margins. So going down into the actual cost of operations, there's the two buckets that Mullen breaks it into, general administrative and research and development. You can see that the general administrative did have an increase in cost for the March 31st quarter. It had an increase of additional $4,669,640. And we're going to break that down a little bit further on another slide. So sit tight. Let's go ahead and finish this up. You can see from a research and development, there was an increase as well, an additional $7,853,559. So for a total cost of operations, there was an increase of $12,523,199. So some of you may be asking, I thought Mullen was planning on cutting back their costs. Well, I went ahead and added their PR into this specific slide, and you can see the PR was dated for April 8th. So that date is outside of this specific quarter for this earnings. So if Mullen starts to cut the cost as is stated in the PR, you can see they're planning as from a cost of operations of cutting $69 million over the course of those 12 months. So that should definitely help cut back on the costs for Mullen operations moving forward. We do know that they're already talking about combining some of those facilities there in Troy, Michigan, with one of the other facilities there to try to help cut back on some of those leasing costs. And they have had quite a few different individuals come in and out in terms of their sales team. So I'll be interested to see what Mullen's able to achieve in this next quarter in terms of reduction of cost of operations. All right, so on this slide, I've got quite a few different things to talk about. The first of which is going to be a little bit of more information in terms of the revenue and the cost of operations. There are some other costs as well, but when you roll all those together, you can actually get an idea of what the actual net loss was for Mullen Automotive. One thing that they do subtract from their net loss is this non-controlling interest item. You can see for the quarter ending of March 31st, there was a non-controlling interest line item of $38,930,288. So that actually got reduced. And then if you took the weighted average of shares for that quarter and you use that in the calculation, that's what Mullen used in order to figure out what the net loss per share was. So Mullen had a net loss per share of $19.39. That was actually an increase in cost compared to the previous earnings in December. Now, one thing that I thought would be interesting again has to do with this less impairment section that I have here in parentheses. You'll see that I did use this as well when I looked over the cost of operations. The less impairment has to do with the reduction for the value of Bollinger as well as in the Elms assets. So Mullen did do a write-off or a one-time reduction in value for those two specific line items, and that impairment amount was added to this earnings report. So if you were to take that impairment away, because like I said, that's a one-time thing, you actually get a much better earnings per share. You get a net loss per share of only $3.95, which is actually an improvement over the previous quarter. So I think that's interesting as well. I used the same weighted average per share. I just removed the impairment costs whenever I took that into account and I did this calculation. So if you'd like to check my math, please go ahead and do so. No problem at all with that. One last thing I want to talk about before I get into the asset and liability column is going to be this stockholder equity additional paid in capital. So this has to do with the amount of money that the shareholders have been contributing in terms of paying into capital for Mullen Automotive to continue to operate as they begin to produce their product and be able to start selling that product for revenue, and then of course for a profit amount that is going to help them bridge that gap. But for the time being, the cumulative amount as of March 31st was $2,151,067,184. That is only an increase, a changing quarter of $16,960,705. So overall, that is the amount of additional money that the shareholders ended up contributing for this paid in capital amount. The reason why that number was not as large as previous quarters was because there was no warrants really exercised in this past quarter. So what you did have is some additional shares that were paid in as part of this employee incentive plan. We'll talk a little bit about that on a future slide, as well as some additional shares that were paid for some liability or some litigations. And we'll talk about that in a future slide. So if you go down past that green bar, we're going to start looking at Mullen's assets. Again, anything that is in red is a negative. It's a reduction in assets. Anything in green is a gain on assets. And then when you look at liabilities, it's going to be the inverse of that. So anything that is increasing in terms of liabilities is going to be red because that's not good for the company. Anything that is getting reduced in terms of liabilities is going to be green, and that is going to be a benefit for the company. So looking into this, let's start with cash and cash equivalents. You can see that there was a reduction of cash and cash equivalents. Mullen used $59,134,175 in this last quarter. So that left Mullen at the end of March with $22,378,089. So we'll talk a little bit about Mullen's financial situation near the very end of this video, but let's go ahead and just continue down some of these other lines. So you can see from an inventory standpoint, this is actually a green line. Mullen did increase their inventory by another $2,242,195. So they've been adding additional product, which we know that is their vehicles, or potentially some of their work in progress, or some of their raw materials from imports. So they netted an additional $2.2 million worth of inventory. So that is a good value to their asset column. In terms of their intangible assets, this has to do with some of their patents or other types of IP. What I did notice is Mullen decided to write off some of the ELMS IP, some of the ELMS patent type of intangible asset line this specific quarter. That had to do with, I believe they said something to the effect of timing in the market. So just kind of wanted to point that out there. So that is a negative on their asset line by $74,757,344. So again, if you are looking for what exactly pulled that asset line down so much, besides obviously the cash burn, was this intangible asset line. And then another one would be this goodwill. So goodwill is the amount that Mullen wrote off at the end of December, and that was that Bollinger and Elms. If you remember, I talked about the less impairment. I think it's interesting that Mullen wrote off the goodwill at the end of December, but when it comes to an impairment, they have that impairment listed in this March 31st earnings report. So again, that's that goodwill asset that has been removed. So that is why it is red there. And that explains why the impairment is in this column. There was $28 million of goodwill in the end of December, which has now been written off for the end of March. Looking at their total assets, so this is just the sum up of everything. There may be some lines that I did not add to this specific spreadsheet, but the totals still jive with the overall earnings. You'll see assets were reduced by $167,056,771. Getting into the liabilities column. First thing is going to be accounts payable. This one actually increased, so they added to their amount that they owe by $7,240,041. So that is the amount they may owe in terms of whether it be on their lease, whether that be a specific note, specific consultants, whatever the cause that may be. We'll look a little bit into that in a future slide, but that is for that column of accounts payable. Looking at the next column, that's going to be the accrued expenses and other current liabilities. So what else was added to the liability bucket? Again, there was an additional $5,025,575. That's the delta that was added to that liability column. The third one down, this is the derivative liabilities remaining. So this has to do with the liabilities in terms of exercising of shares, has to do with a little bit about warrants, as well as if there's any shares that are owed. Mullen actually taking care of those shares and getting those to the individuals, whether it be consultants, whether it be employees, getting those shares kind of distributed amongst. So you could see that at the end of December, Mullen still had a liability of $20,714,620. But they actually reduced that down to 5.1 million. So they reduced their liability in that category by $15,590,133. So that was a good thing they were able to do this past earnings quarter, was reduce that derivative liability, which again is tied to the share count. You'll see the next section down there. This is the lease liability. So the current portion, meaning what is actually due now. This is not the roll up of the 12 months. You can see that they had a reduction in terms of lease liabilities by $995,000. And you'll see notes payable. You can see this is their debt. Mullen did talk about this in their last earnings. However, they paid the note in January, which means it takes effect in this specific earnings report. So you can see they went from 7.6 million down to 2.7 million. They actually paid off in full the facility there in Tunica, Mississippi. So now that building is owned outright by Mullen Automotive. Again, that is a positive in terms of their liability. They reduced that liability from this notes payable by $4.9 million for the quarter end. So total liabilities, there was there was a decrease in total liabilities of $12,657,317. So that is a good reduction for Mullen Automotive. They were paying some of these bills, or if you will, some of these loans off. There were some increases. I already talked about those, but overall they actually netted a benefit by reducing that liability column. And then one other line item I did want to talk about, I thought it was very interesting. Mullen has a spot where they talk about purchase of equipment. So if you recall, there was a purchase of equipment in the quarter ending December, about $6.8 million worth, and this could have been some of the Fullerton location getting some equipment. Potentially they may have paid for some of the Romeo Power assets in the last quarter. I know that the announcement was in September, but potentially that could have rolled into the month of October when they made their payment. So just keep that in mind. But what I found was interesting is Mullen, between the months of January and March, they purchased additional $5.6 million worth of equipment. So they are scaling up. Don't know exactly which location this equipment is for, whether it be at the Fullerton location. We did see some of their machinery there, or if they added any equipment to the Tunica, Mississippi facility, or maybe at the Troy location. We don't know, but I thought it was interesting to show that Mullen did increase. So they are adding to their investment of $5.6 million. All right, and I broke down some of those categories a little bit further based on what Mullen shared. I grabbed some snippets from the previous earnings report and just kind of put it line by line right next to the current one. So if you look on the left, it's going to be Mullen's current earnings report, and if you look on the right, it's going to be Mullen's previous earnings report in December. So prepaid expenses, you can see overall there was an increase in prepaids. So Mullen has been adding some money into their prepaids. What exactly was getting added? Let's take a closer look. You can see from a prepaid services, there's an additional approximately $5 million added to prepaid services. If you look at prepaid inventory, there is an additional about $3 million worth of prepaid inventory. So again, is this additional equipment? Either equipment, or is this additional vehicles, raw material that Mullen has already prepaid for and could be getting shipped in the near future? Looking into a few of these other line items, you can see from a prepaid trade show, this one was actually reduced quite a bit. You know, Mullen didn't have their strikingly different tour going on, so there was no kind of shows to be paying for in terms of this quarter ending. But you can see back in December, there was a total prepaid trade show of $3.7 million, whereas for this quarter end, prepaid trade was only $83,000. So overall, just want to kind of share a little bit about their prepaids and how that breaks down. And at the bottom, we're going to break down the general and administrative costs. I did find some very interesting sections in here. I did want to break those down a little bit, so let's get right into it. So first thing I want to show is going to be, you'll see the 3 months end March 31st and then the 6 month end March 31st. So if you think about it, if you take the 6 month end values in that 2024 column and you subtract from the 3 month end 2024 column, that delta is going to be what they paid for the previous quarter. So it's a little funny math. If you want to do that on the fly with me, go ahead. But you can see from a professional fee standpoint, it's about even. If you figure $30.6 million for 6 months, these past 3 months, they paid $14.4 million. So if you were to double this specific 3 month quarter, it will be about $28.8 million. Again, so if you did look at that, they spent a little bit more on professional fees in the December quarter end, but not too much. Wanted to really just flag a couple of the higher amounts. So if you did look at that settlements and penalties, you're going to see that is increased. So for the 6 months, there was only $8.6 million total for settlements and penalties, whereas just in the past 3 months, there was $6.7 million in settlements and penalties, which means that for the December month, there was only about $2 million that were paid out for the settlement and penalties category. Looking a little bit further down, you're going to see compensation to employees. At first, I kind of scratched my head and thought, was Mullen reducing their staffing? But I did recall that in their previous earnings reports, they did talk about making a shift into their ERP system. So what I believe they are now doing is their direct team members are going to be logging their hours against cost of goods sold. So as these vehicles begin to be sold and that revenue is realized, there's also going to be the cost of goods sold realized as well. So I believe that is why the compensation to employees has been drastically reduced, as well as the employee benefit column or line item. If you look at those two, you're going to see that for the 6 months it was $9.2 million, but for these past 3 months only $1.9 million for compensation. So that would leave about about 7.3 million or so would have been utilized for the 3 months ending in December for compensation against 1.9 million for the March ending quarter. So as I mentioned, I believe that offset is going towards now cost of goods sold, and we'll be able to notice that hopefully in this next earnings report coming out here at the end of what do we have here? It'll be the end of June, but we'll probably be getting it about mid-August. So hopefully on that mid-August earnings report, we will see some of those costs of goods sold from these employees getting added to those lines, and we'll see that because there should be some significant revenue based off of some of Mullen's latest PRs that they've been sharing. So going down a little bit further, just looking at a couple other line items, you will see the lease line item. So for the 6 months, Mullen had paid a total of $972,000 for leasing, whereas for just these past 3 months, they spent $774,000. So their lease category did go up in the general administrative category just for these past 3 months. And then there's an other line item. I'm not sure exactly what's on the other line item, but you'll see there what was $4.6 million for 6 months. Just this past month was $3.7. So that means the other line item was about $1 million for the December ending quarter, and it's $3.7 million for this quarter end. So overall, if you just looked at the general administrative, it would be $91.1 million for the 6 months versus $47.9 million for just those 3 months. So there was a slight increase overall for the general administrative category, and you did see that on one of the previous slides if you were just rolling everything up onto that. But I did want to break down a little bit some of the general administrative and kind of see how this is all falling into place. And we will see how Mullen is planning on reducing some of that cost. As they did mention, $69 million coming off of the cost of operations. So it's either got to come from the R&D section or it's got to come from this general and administrative category. So it will be interesting to see those 12 months, how that $69 million is going to be spread out and reduced for savings. All right, and one other thing I did talk a little bit about was that derivative liability. I wanted to just break down this liability to issue stock category. You can see here on March 31st, 2024, this is the end of quarter. There was a current liability in amount of $7.8 million. And some non-current liability in the amount of $500,000. So what all that comes from, you'll see that there is a CEO incentive award that has a current liability of $2.6 million out of that 7.8, and then you're going to see some additional shares to be issued to certain investors upon those warrants of being exercised, and that is that 876,192 shares. So those are those warrants that Equitas still owns, and those have a derivative liability of $3.7 million. So again, just kind of wanted to break that down a little bit. And then there's some for contracts and consultants that comes out at 1.3 million. And then overall other parties, another 0.2 million. So just kind of wanted to share that with you a little bit and show you how that derivative liability, how this liability issue stock is broken out. And if you do recall, David Mishry has deferred recognizing or receiving some of the stock-based compensation that you've seen in some of these milestone awards. So I think that's interesting as well. It does say something about the CEO that he understands that the company doesn't want to be burdened with having to procure and release those additional shares to him, whereas they need to be able to use some of these shares as cash, as capital, to be able to keep the business going. So I did want to say that I do think that is a positive thing that David has decided to, for the time being, defer receiving of that share-based compensation. So a couple things I do want to show as well down here. I already talked about it, but just want to kind of show it to you in another way. This has to do with the machinery and equipment. You can see that in the December ending quarter, it was about 31 million, and in the March ending quarter, it was at 34 million. So that's that 3 million increase on machinery and equipment. You'll also see a small increase in buildings, so a little bit more in terms of value in the asset column for buildings. So overall, though, there was a small decrease in property, plant, and equipment. So you may be asking, where is this decrease coming from? And it is in depreciation. So if you look at the overall total cost of assets, excluding the impairment, there's actually $5 million getting added in for this end of quarter March. But if you do look at the accumulated depreciation, that has that increase almost about 9 million. So that's why it does look like the property, plant, and equipment is being reduced in value in terms of the asset line. So like I said on the last slide, I did talk a little bit about the CEO, David Mishry, not taking some of those stock-based compensation shares. And you'll see here that for the 3 months ending March 31st, this is going to be the first two columns here. You'll see one for 24, one for 23, and then the right-hand side, that's going to be the 6 months ending March 31st. And again, we're talking about 24 versus 23. So looking at the 3 months, you'll see that there is a negative $6.24 million that David Mishry has not received. He's deferred that award for the time being. So that is still sitting there as a balance. That is a liability that the company has to eventually provide him those shares. But for the time being, he is deferring those. You will see that from a share-based compensation to employees and directors, there was an increase of $3,487 or $487,105 for the 3 months ending in March versus that 5.4 for the 6 months. So there were additional shares being provided for these first 3 months. Looking at from a consultant standpoint, there was a reduction in consultants in terms of compensation, whereas the 6 months was 1.2 million. This 3 month ending is only 206,000, so about $1 million versus 200,000, comparing the last 2 quarters. And then the last section is going to be the share-based compensation to consultants. Again, this is $4.2 million for the quarter ending March, comparatively to the 6 months of 14.9 million. So that would actually mean there'd be about 10.5 or so, maybe 10.6, 10.7 million dollars were provided to consultants in the December ending quarter, whereas in the March ending quarter, it was only about 4.2 million. So overall, if you recall, as I mentioned, the CEO has deferred his shares. That means that overall, there was only $1.7 million in terms of share-based compensation as an expense, versus in the 6-month period being 15.6. So a pretty significant reduction in stock-based compensation for all around between employees, consultants, and the CEO. The first one, this has to do with that $5 million promissory note that Mullen did pay off. If you look at the last sentence for this first section, it says in January 2024, the loan was paid by the company in full and the collateral was released. So this has to do with the property at 1 Green Tech Drive, Tunica, Mississippi. So this is their Tunica plant. Mullen Automotive outright owns this plant. They already outright own the Mishawaka plant. So as of the end of March, they now have 2 fully owned facilities, therefore producing vehicles. The bottom section, this was that terrible promissory note that everyone was concerned about. There's a lot of talk, a lot of drama behind it. It was a $50 million note. $32 million was going to be used towards the cost of operations, and there was an $18 million basically credit. So Mullen would be receiving $32 million, but they would have to pay back $50. And we did find out through some of the filings, I believe it was in Mullen's 10Q, for the December ending quarter, we did find out that that $18 million had to do with a settlement between Mullen and Isusa. But Mullen did let all of us know, all of us shareholders know. I'm going to go ahead and read this last sentence here. At this bottom, it says, the funds contemplated by the debt agreement have not been received, and on May 7th, 2024, the debt agreement has been terminated. So Mullen did not have to borrow 32 and pay back 50. This specific note was outright terminated. If some of you do know, I did speak about this many months ago, back in December when this thing was announced. I said, well, what if Mullen decides not to take this note? And lo and behold, as of May 7th, this thing is terminated. So now let's go ahead and get into some of the litigation items and what other line items Mullen will be paying. All right, so if I can get you to look at the bottom left of your screen, there's a table here. This table is going to kind of reflect the next few slides that we talk about in terms of some of the litigation. And that's because there are certain settlements that Mullen is acknowledging that they will be paying out. So if you do look, again, this is the March 31st quarter end, you're going to see provision for settlement expenses and legal fees. So Mullen has earmarked away $34,865,306 for settlement expenses and legal fees. The rest of those are just taxes, accrued payroll, accrued interest, refund liability, and some other accrued interest. So overall, or accrued expenses. Overall, this is one of the expense line items. I put it here instead of in one of the previous slides just because this $34.8 million has to do with some settlement expenses and legal fees that Mullen plans to pay out in this quarter. So the first thing is this TOA trading. So there was litigation in terms of a finder's fee with TOA and Mullen Technologies. When Mullen and Net Element were doing the reverse merger, this specific company wanted a finder's fee, and according to this specific section of the earnings, it does say that the company has accrued expected settlement expense as of March 31st, 2024. So Mullen will be taking care of this litigation now. All of the pre and post judgment, all of the awards and everything like that for this case has been kind of closed out now. So Mullen will be basically paying off this litigation. We don't know what it is. I did go through this specific lawsuit. I can't find the exact value, but it would be part of this $34.8 million. The next section has to do with drawbridge settlement, and it does say that this has to do with Drawbridge did want some additional shares, and Mullen was kind of going back and forth with Drawbridge on that, and Mullen has settled to pay $1.95 million, and this is as of March 31st, 2024. So this is going to basically take care of this claim completely. So both the TOA trading litigation and this Drawbridge settlement are now closed out. There are a few more on the next couple of slides, but just remember this $34.8 million as we continue along. In terms of some more litigation, there was this Margaret Schwab versus Mullen Automotive Inc. And this had to do with one of the shareholders or stockholders. They did file a class action lawsuit against Mullen Automotive, and this had to do with their PR, some of their announcements. As you all know, if you have been a long-term holder or a long-term interest in Mullen Automotive, they were planning on releasing their Mullen 5, actually back in maybe 2021, 2022 time period. Unfortunately, that vehicle did not get launched back then. So some of the shareholders, they looked at that PR along with a few other PRs that were forward-looking, but there were some items within those PRs that had some leg to stand on alone. So according to this specific section of the earnings report, at the very bottom here, you can see that the company has accrued expected settlement expense as of March 31st, 2024. So again, that $34.8 million, part of that is going to go into this specific litigation, this specific lawsuit. Looking at the bottom left, this has to do with a debt agreement for a convertible note. Actually, this is the section that I talked about. This is that $18 million for Isusa. So if you look through here, it says near the bottom here, it says the $18 million settlement cost has been accrued as of September 30th, 2023, and is included as accrued expenses and other liabilities at the March 31st, 2024. So again, this $18 million, instead of opening up a $50 million note, as Mullen was going to do back in December, Mullen is going to go ahead and take care of this $18 million. The bottom right, this has to do with Silverback Capital. This is another liabilities settlement agreement. This has to do with overall liability for vendor up to $4.6 million. Again, this at the very bottom says the agreement, enforceable upon court approval, aims to fully settle the specified liabilities without cash outflow. So it looks like Mullen will be settling this $4.6 million using shares. So instead of having to burn through additional cash, they will be utilizing some share capital. So if you're looking at what Mullen's trading at now, it's about $4.60 or so. So you're looking at about 1 million or so shares will be provided to Silverback Capital to help close out this specific settlement agreement. All right, so now that we've gotten some of the litigation out of the way, let's talk about some good news for the company. They have been able to secure some financing. The first financing I want to talk about is going to be this $50 million note with warrants attached. This is as of May 14th. They entered into a security purchase agreement with specific investors for some senior secured convertible notes as well as some warrants. The initial amount to be converted is going to be $12.5 million, and that is the value for the note, but the investors will be getting $13.2 million because The 12.5 million has an inverse discount, so the lender will be receiving 13.2, and they will be getting that 13.2 in terms of shares, and then after this first 12.5, there is an additional 37.5. Again, if you invert that discount, the lenders will be able to exercise an additional 39.5 million worth of common shares, and they will receive some warrants on top of that. So let's go ahead and read through what all the requirements are for this specific financing to take place. First off, the company has to have sufficient authorized shares for the common stock, up to 250% of the current common stock. If you do know, Mullen has up to 5 billion shares that they could be utilizing. And if you look as of May 9th, there was only about 11 something million of shares being used. So there's definitely enough shares available for this specific financing. So number two, the common stock has to have an average trading volume of 3 million shares within the last 10 trading days for this SPA. The third section, there has to be a registration statement covering the common stock, talking about the conversion of the notes and the exercise of warrants have to be declared effective. Number four, the company has obtained stockholder approval for the issuance of the notes and warrants in compliance with the NASDAQ rule. And I believe the NASDAQ rule is anything greater than 20% requires a shareholder vote. So as long as the allotted shares stay under 20%, this specific secured note will continue to process. Section 5, Section V, the company is in compliance with the continued listing standards of the NASDAQ capital market. So we know that Mullen did get fully reinstated in the NASDAQ. They did get that annual meeting taken care of, as well as they have been trading above $1. So again, with all those sections in the green, this specific SPA can go ahead and begin. And again, there is another caveat as well. It says each investor may terminate their obligation to purchase additional amounts under the SPA agreement if the funding conditions as well as closing conditions have not occurred for a period of 3 months or longer. So if this SPA doesn't actually get kicked off, if they're not utilizing it within 3 months, these investors can go ahead and cancel the funding of this note. And then in terms of the notes, so these convertible notes for the company, if they choose for some reason not to provide them with shares, if they didn't want to pay for them out of cash, they do accrue an interest of 15% on top of the 5% original issue discount. And this does mature for 4 months. So basically, the longer that this SPA remains open, the higher the value will be in terms of what will be converted for shares. So if you remember, the 12.5 has that 5% discount, gets the 13.2. So there is that additional 15%. So that 13.2 can grow in value each month as they continue to hold and not exercise this SPA. We want to go ahead and talk about how they are converted. So there's a couple different ways, and it's going to be the lower of these ways. So the first one is going to be the lower of $5.49. So no matter what the share price for Mullen's shares are, if let's say for some reason it hits $10 a share, these notes will still get converted at $5.49. So that is the ceiling for this note conversion. The second caveat, which would be a potential lower than $5.49, would be 95% for the closing sale price for this common stock on the date for this company's registration statement on this S1. So we haven't seen an S1 specifically for this $50 million note with warrants attached. There was a different proposed S1. I'm not really going to talk about that in this earnings report. But if that S1 does become an actual S1 and there is a shareholder vote needed for that, we'll talk about that in a future video. So again, if that S1 is declared effective, if a S1 tied to these notes becomes effective, then it could be the ceiling would be 95% for the lowest daily volume weighted average. I'm sorry, that's the third one. The second one would be 95% of the closing sale price of the execution or the declaration of that S1. Section 3 or number 3, 95% of the lowest daily volume weighted average for the past 5 trading days for the conversion date. So let's say they want to convert on a Friday, they will have the lowest price for the previous 5 trading days. So the previous Friday, Monday through Thursday, the lowest of those days, and it would be 95% of that low value. That would be what they would be able to convert those, purchase those shares for. And again, those dollars are going back into the company. Number 4 has to do with, as part of number 3. So in the event that the share value does drop significantly, it does have a floor. So the floor is at $1.16 per share. So that is the bare minimum that Mullen is willing to sell these shares to the investors for. So if you are concerned with additional shares being purchased under $1, which could impact their NASDAQ listing, that is not the case. There is specific contingencies written in that protects that value by keeping the floor at $1.16. All right, in terms of warrants that are attached to this promissory note or this SPA note, it has to do with the holder will receive 5 years to exercise these warrants, and they are exercisable for 200% of the shares of common stock for these specific notes. So for instance, let's make it easy. If the investor purchases 1 share of common stock, they are entitled to 2 warrants. So that is the conversion rate. So it's for every 1 share purchase, the investors are going to be getting 2 warrants. So keep that in mind. And those warrants are exercisable at a price equal to 105% of the closing sale price of the common stock on the execution date. So whatever date the warrants are exercised by these lenders, they're going to be able to get them at 105% of the closing price for that day. Again, these are all exercisable on a cashless basis, and it has to do a little bit with that Black-Scholes value. Again, if the company meets the funding conditions and the VWAP for each trading day during the 10 trading day period immediately preceding the date on which the company elects to exercise this option is 250% above the exercise price, the company will have the right to require the investors to exercise the warrants for cash. So that is interesting to say the least, because for instance, if the company ends up finishing the rest of the promissory note and the volume weighted average price for 10 trading days after the company closing out the conditions are met, the company can actually exercise these warrants. They'll have the right to require the investors to exercise the warrants for cash up to 250%. So that is interesting. So Mullen can actually purchase these warrants back from the investors if they so choose to do. So in the event Mullen has some significant improvement and their revenue is just exploding, and now the share price is worth a lot more than current state, and it's worth more of the fair value for the company, they may choose to go ahead and just outright purchase these warrants from the investors instead of allowing them to exercise the warrants at that much higher price. So that's another interesting thing that Mullen has written into this SPA. All right, the second paragraph, don't want to read too much into this, just basically says the companies agreed to file a registration statement for this SPA. The third paragraph down talks a little bit about the company will be restricted from issuing additional securities to other parties for a specific period of time. And so that kind of protects this investor from any other lenders coming in, getting additional securities, and then being able to kind of exercise warrants and kind of, impact their current investment that they have here with Mullen in terms of their shares. The last section here talks a little bit about the notes and warrants. Again, they can be converted by an individual holder. However, they cannot own more than 9.9% of the common stock. This is something that has been in previous SPAs, but now it's even more important because of the shareholder rights agreement that was put in place. And this was back, I believe it was on, might have been May 13th. But for that specific date, there was two circumstances or two triggering events. There was a flip-in event and I believe a flip-out event. Flip-in event would basically happen if an individual obtained more than 9.9% of common stock. Again, Mullen Automotive would have to approve that from happening, and there was a price or a fee that they could charge that individual for owning more than that amount of common shares. And then that flip-in event would allow all of the common shareholders, except for this one specific investor, to purchase shares at a discount, as well as being able to obtain, if they choose, that junior A1 preferred, double A1 preferred share. So just wanted to kind of put that into perspective. This information was written in as well. And then it does say that that the notes and warrants may not exceed 19.9% for the total numbers of common stock. Again, that's because if that was to happen in that event, there would have to be stockholder approval as per the NASDAQ listing rule there 5635D. So just kind of wanted to put that all into perspective. And in the last section there, pursuant to this SPA, investors may exercise within 1 year an additional investment right under the identical terms. So interesting, if this investor does choose, they could go ahead and take out another $50 million promissory note under these same terms within this year. And again, this is just money that Mullen will be able to utilize towards operations. This is helping them stay afloat while they start to make sales and scale up their operations. All right, thanks so much for sticking around. This is the last slide before the outro. Just wanted to share a little bit about the payment for the securities in this SPA. It says on the closing date for the initial closing, buyer shall pay its pro rata portion of an aggregate of $12.5 million. That's the initial price. And at a later date, on the second closing date, the buyer will pay their pro rata portion of $37.5 million. That's the second purchase price. And again, they are going to get the 12.5 for a pro rata portion. They're going to actually receive 13.1 million in value of common stock that they have the choice to purchase with, as well as those warrants that I mentioned. And then for the second, this 37.5, they're going to be able to get, and this is that 5% discount, they're going to be able to get 39.4 million worth of common stock, as well as the warrants. There, outside of the 50 million, there was an additional 100 million in financing through senior secured notes and warrants. Again, I'm not going to go through as much detail as I just did on the 50, but you will see on the right-hand side, this buyer, this is Asusa Group Holdings, this is Michael Wachs, This is Justin Davis Rice, Jim Fallon, Jess Mogul, Michael Friedlander, Phil Bannister, Matthew Krieger, and Mario Silva. So those are all the buyers for this specific financing agreement. So this $100 million worth of financing agreement, this is going to be set up into 8 tranches. Each tranche is going to be 12.5 million, and this is going to be paid over the course of the next 13 months. These investors are going to get $4 million up front as a commitment fee in terms of stock. So they're going to get $4 million worth of stock right away. And then outside of that, you can see some of the terms here. I'm not going to read through all of them. There's a lot here. And then again, I would encourage you, if you haven't already, you can actually click on some of the exhibits at the end of the 10Q, and you can read in detail some additional information in terms of the security purchase agreements, some more about the terms, some more about just the overall details. But I did want to just share just high level what Mullen had shared in at the bottom of their 10Q there. Outside of this, this does set Mullen up for $150 million worth of financing. And then I did want to mention at the very bottom here, I did add another paragraph, another snippet. It does say, if the company does not secure adequate funding to fulfill its current liabilities, it anticipates seeking bankruptcy protection in various jurisdictions within 30 days of publishing these financial statements. So again, that is if they cannot get this 50 million note with warrants, or this $100 million financing arrangements kind of off the ground running within the next 30 days. They will be looking at bankruptcy protection. However, this has probably been in the works for quite some time. That is why Mullen did cancel that $50 million promissory note with Isusa. They now have this other terms in terms of security purchase agreement for financing. So again, near the very bottom, it does say, as part of its cost-cutting measures, as I mentioned, there was $69 million in cost of operations they're looking to reduce. The company plans to further reduce its workforce and streamline operations. So I believe they did mention that Troy, Michigan location. They were looking at doing some merger with either their California base or their Michigan base to kind of reduce the overall building leasing that they have currently. And then they may look at some redundancies in terms of workforce if they have some engineers that are covering, let's say, the Mullen 5, and then the same engineers are covering, these Class 1 cargo vans and the Class 3 trucks. They may take a look at all of those individuals and see where it makes sense to kind of merge departments. Again, let's continue reading through here. It does say, including downsizing with physical locations, as I mentioned with the leasing. However, there is no guarantee that the company will be able to restructure its debts and or secure necessary financing on favorable terms. So it will be interesting to see what Mullen does come through. If any of you have been noticing at all, Mullen did have an additional 8K come out on Friday evening, and it went over another SPA. So Mullen is actively getting financing to take them through 2024 and through some, if not all, of 2025. So we'll have to see how Mullen does in terms of financing and what Mullen is able to capitalize on with these funds in short term. So thank you all so much for watching. I hope you really enjoyed it. If you did, please consider giving this video a like. If you haven't, please subscribe to the channel. Leave me a comment. Let me know your thoughts on this earnings report. Leave me a comment and let me know what other types of content you'd like to hear me cover. Again, I am not a representative of Mullen Automotive. I am not paid by Mullen. I am just an investor who is still very much bullish on the company. I do hope that you enjoy this video. This, of course, is not financial advice. This is information only. And I hope you all have a great rest of your days, and I'll see you on the next one.